Good morning, Ken. How are you?
I'm doing well, Gina. How are you today?
Good. Happy first day of February.
Yeah. Boy, look at that. We're a month into the new year already.
I just cannot believe it. I was talking to my mom yesterday and I was like, no, it's not February. We just had Thanksgiving. She's like, she even warned me. She's like, the older you get, the faster time goes. And
Absolutely. Absolutely.
yeah, but thank you so much for taking the time out of your day to join me.
Oh, happy to be here.
This is always one of my favorite times is having Facebook Lives with you. So I appreciate it. So I know today's topic, you want to tell us what it all is about?
Sure, sure. Well, I titled it, It's Not What You Make, It's What You Keep That's Important.
Ooh, I like that. That should
Yeah,
be
yeah.
your life motto there.
It follows the theme of my firm, which is if there's important information, if there's a critical fact, something that you need to know to make sure that you're making a decision, a financial decision
Mhm.
that's in your best interest, when would you want to know about it? And of course, you'd want to know about it before you made the decision. You want to know about it right away.
Mhm.
And so I relate that to this kind of quirky way to say that it's not what you make, it's what you keep. But how do we crystallize that? What does that really mean?
Mhm.
And what it means at the heart of it generally is it's not the gross income that's important. It's the net income. That's what you get to spend.
Right, right.
And that's lifestyle money. That's money that relates to, okay, I'm retired now. How do I do those things that I want to do?
Mhm.
Travel, hobbies, and of course, just covering the day to day. So, again, that's the money that's available for lifestyle. And generally speaking, most all clients are going to have Social Security coming in. So, we know
Mhm.
that. But there's also that need to very often dip into the well, dip into the retirement funds and the savings and so on. And there's really no simple rule associated with how do I take money out of these accounts. However, there are some standards that we want to talk about that get into the idea of net versus gross. At the
Mhm.
core of it, what it means is taxes are going to be involved. All right. So, taxes are part of it. Fees are part of it. Hidden fees are part of it.
Mhm.
Um, and at the core of it, there's inflation as well.
Right.
So we want to look at what is my net result as I go through this. You've got goals, you've got income needs, but most all retirees want stable cash flow, and many want to leave money to their heirs.
Yeah.
So it's really a personalized story. And I'll get into that a few layers deeper today, all about personalized strategies.
So what are the challenges? Surely you're going to talk about taxes.
Yeah, absolutely. We're going to talk about taxes. Before I get into the taxes, let me set kind of maybe a mindset or way to be thinking about how to listen to this information and actually act on it, and actually,
Yeah.
in your mind, give it. How does that relate to me? So, very often I'll talk to prospects. And those that just have questions about the practice and how do you help people and so on.
Yeah.
And I'll ask them, have you ever wondered, am I on the right path?
Mhm.
That comes out many different ways. It could come out with a statement like, do I have enough money to retire?
Mhm.
Or I kind of turn that around sometimes. How much money do I need to retire? Right. So, that's framing that, am I on the right path? And I'll give you an example, and it's just a personal story that to help relate to that. I fly into Chicago very often. And
Mhm.
so that involves going to O'Hare Airport
Mhm.
more times than not. And Chicago is a place that sometimes is really, really a great place to fly into in July because it's nice and warm and it's a
Yeah.
fun place to get on Miracle Mile and so on. But I'm coming in one day when it's one of those rainy, windy kind of days. I'm flying in the same day that I'm going to register for the conference, and I need to attend some meetings late in that day. So I'm in a hurry, and I'm gathering my stuff, and I'm, headed to the hotel shuttle pickup area. And I got wet, I got messy, and it was just this whole ooh.
Yeah.
What a way to start,
Mhm.
right? Lo and behold, when I get there, is the same gentleman that I was sitting next to on the airplane, and
No.
he's dry. And I walk up and I said, dude, how did you get here before me and you're dry? He says, well, oh, didn't you know that there's an underground corridor that will take you away from the traffic, away from weather, and you get here faster? And I'm like, no, never do that. And so he went a different way. I went a different way. And I'm thinking about that on the right end of the hotel. And I said, so I learned that there's another way to get to the hotel shuttle pickup area, and I could have stayed dry and so on. So I'm just curious, why don't you talk to people about that and let them know that, or just in any way? And it was precious. The response was, well, it's complicated. So we find it difficult to explain to people. So we just tell them, find the crowd and follow them to the hotel pickup. Really? That's what I mean by, are you on the right path? Are you on a sheltered path here? Absolutely. The biggest cost associated with taking income and growing money is the cost of taxes. So laser focus on taxes. And I'm talking about tax cheats.
Mm-hmm.
I'm not talking about skeletons in your closet, but I'm talking about understanding the tax code, understand taxes well enough, or through your advisor, being advised properly enough to be able to make decisions or endorse the decisions that you're being made that are in your best interest. Many retirees have done a fantastic job of saving money. They've gotten to the mountaintop.
Yeah.
That's the goal. I've saved enough money, and we go into the planning software and we get a good idea that they've got, enough assets. Now, is there going to be enough net result as we go through this whole process? And in most all cases, the big difference maker is going to be the cost of taxes in retirement.
How so, Ken?
Yeah. So here we're going to take a step back for a moment and have everyone say, am I doing what everybody else does? I've taken my tax return to the preparer. Oh my gosh, I got a refund this year. I must be doing pretty good. That's great. Or are we in a situation to where we have this gut feeling? Is there something different I could be doing? I overheard a conversation, or the neighbor was able to do this. And so there's this inkling, and there's a little bit of a quirky saying that I have about this. And it's fun though, but it says, if you change the way that you see things, the things you see will change.
Manifestation.
Yeah.
I like that.
And to couple that in, Albert Einstein was quoted as saying something I thought was just, now Albert Einstein, a brilliant dude, right? And he said, the hardest thing in the world to understand is that there's hundreds of thousands of pages of tax law there.
Yeah.
And so the point that I want to bring up, or I want to help people to begin to understand is it's all in the language that they use. When you read this stuff, it's like, what does this even mean? How does it relate? So I'll give you a great example. I'll walk through a couple of examples of what I mean by that, and it can be helpful, because we see it every day. Look, we're in tax season, so, it's really good that we give a little extra emphasis on that. Here's one of the beginning points. There's this thing called adjusted gross income. Now, how is that different from income or taxable income? Okay. And so we think about it and go, well, I'm not really sure. What is it? Well, adjusted gross income is before deductions. Okay. So deductions start to play in. So then while you're thinking to yourself, they put together this code that doesn't relate to our everyday language. And what I will tell you is understanding the difference between those first two is one of the primary moves to lower income taxes. Okay. Lower your AGI, your adjusted gross income. So tax people talk about that like it's kind of this, second sense about what to do. But what does that really mean? Lower my AGI. So So that's a beginning point. Now, let me give you an example of what I mean by this, right? And an example would be this thing called a qualified charitable distribution. Now, I've focused this on to the retirement community. And so this is for someone who is age 70 and a half, or in today's world, they've changed the law twice in the last 3 years. So when you're required to take the minimum distribution, that's key pivot point number one. And it's really only related to an IRA, not an employer fund. Remember, employer funds are owned by the company.
Right.
Okay, we're plan participants. So in order for you to get a personal benefit out of that, then what needs to happen is that it needs to be in an IRA. But there's a huge annual limit to it. It's $100,000. So you can give a lot of money to this. And this qualified charitable distribution, this satisfies the required minimum distribution, and it's a direct transfer that's necessary in today's laws in order to have this happen. Now, how it works in real life is, let's just give an easy example. You're given $10,000 a year to the church. Okay. Many people give to qualified charities. It doesn't have to be the church. It could be Red Cross. It could be any qualified charity, nonprofit. Now, when that scenario plays out, typically when we give, before learning about this, we go into the church, using that example. Every week we put a check in the basket, or we pay monthly, or however we're doing that. And over the course of a year, we've donated $10,000. Now, that is after-tax dollars. That's something we're going to do every year. We're going to tithe. We're going to do it every year, but it's after tax. We already paid tax on that. So if you're in a 20% tax bracket, $10,000 costs you what? $12,000 to give. Okay, because we already paid the taxes on it.
Right.
Now, we can take that same $10,000 and give the same $10,000 to the church. And now all of a sudden you've saved $2,000 in taxes. Why? Because you were able to take it out of a tax deferred instrument called your IRA, and you've been able to give that to the church directly. So therefore, there's $10,000 that you won't ever pay taxes on. And it's a real tax savings because, look, if you're using taxable money to give, we'll get a tax deduction or a tax savings of $2,000 on the federal tax return. So that's a simplistic way to understand the qualified charitable deduction distributions. And so the point of it is that if you know that, and it applies for you, can have some real benefits to lower the AGI, the adjusted gross income.
I love the examples you give because it just puts on such a better understanding on the explanation. So I appreciate that. Okay, so I got the AGI versus taxable income. Anything else?
Well, yeah, absolutely. The tax code goes on and on and on. And so, look, so if AGI wasn't confusing enough, and it's not necessarily so confusing, it's just, how do we apply it? What does it really mean? And that's what I'm focusing on, is what are the definitions of these crazy. So now they've got another one. It's called modified adjusted gross income. Can you imagine? Only the government can make this stuff up, right? So the IRS has come up with this modified adjustment of gross income. And here's how it applies. Again, focusing on that retiree, that person who is pre-retired or moving into retirement here, they have something that happens to them at age 65. And that means that they get to sign up for Medicare. Now, the prevailing thought process for most all of us, that process is all about the idea of, oh my gosh, am I so glad that I made it to 65 because now healthcare is free. Medicare is going to pay for it. Well, we know that's not true, and we kind of walk through the basics at the beginning part of that process. But then we begin to understand that there is a cost for Medicare, and they like to take it right out of your Social Security too. They like to do that, but they'll bill you for it. And so there is a cost associated with that. So we're tuned into that. Most all of us are okay with that as we get into that first phase of planning with our clients, and we help them to understand that. Now, here's the gotcha that the government has come up with the modified adjusted gross income. It applies to this acronym called IRMA, IRMAA. That is the income related monthly adjustment amount. Again, only the government can come up with this kind of stuff. This applies to high wage earners. They have the privilege of paying more money because they have more income, and paying that money into Medicare. It starts with the married filing a joint return about $194,000 in this particular tax year. That's another $165 a month on top of what they're already paying. And that number is about $160, $170, $180 for the average person. Goes all the way up to $560 at the top. Ooh. So on top of the couple $100 that might be paying now, I say per month. That's more on a quarterly basis. They aggregate it on a quarterly basis.
Okay.
So I misspoke there. But these are the numbers now that are going to come out that are equated to that amount per month. Those are big numbers when you carry into retirement. Now, here's what's also interesting about that. They formulate your income based on your age 63 income tax. Well, most people are working probably at the highest level of income at age 63. They're pre-retirement. They're making big bucks. They're senior positions or whatever their profession is. And now all of a sudden they're going to use that. They have a 2-year look back period is what it is. That's what the IRS does. So likely most all getting into retirement are going to need to have some kind of conversation with themselves about, okay, how do I tune into Medicare? How do I make all this happen for myself?
That is so interesting to learn.
And for the typical retiree, about that after the fact. So it relates back to what path am I on? And is it the right path?
Right.
Is there some planning that can come into play here? For some that may not be high income approaching retirement, but they may be contemplating, well, I'm going to sell that house. I'm going to create some income or sell an asset. And we say, okay, that might be the right thing to do, but time out for a second. Mm-hmm. Do the math. Is this where you want to be? Or would you be better positioned differently? That's not advice. It's just to recognize that the math will tell us which way we need to go.
Right.
But there's something else even funnier as we kind of transition through this tax conversation. And that is, did you know that there's a 0 tax bracket?
0. 0?
I always put that out there because, and many people will say, well, yeah, of course it's 0 if I make little bits of money, then, I don't have to pay taxes. But I'm not talking about that. There is a 0 capital gains tax. So a moment ago, I was talking about this idea that you might sell something prior to retirement.
Yeah.
And it might throw up the IRMA or the income adjustment, right? Okay, well, along with that is the typical capital gains tax, which you can have income, taxable income up to $84,000 as a married filing a joint return and not pay anything on capital gains.
Wow.
So the question becomes, how do you position your capital gains taxes or the sale of an asset, especially a large asset? So we spent some time on that one as well. So just a side note, I always try to catch the attention. There's a 0 tax bracket. Whether you can do it or not, I'm not sure of. But the point is, 0 has that nice little ring to it.
Well, I really like to hear that 0 tax bracket. It sounds really nice.
Yeah, 0 is a great tax bracket, and it's easier said than done. It takes planning.
Yeah.
And it does go against conventional wisdom. Remember, I talked about, the whole story of, are we following the crowd,
Right,
or
right.
are we willing to step aside for a moment and go through the motion to determine, is this in my best interest? And how do I know that? So one of the first things I typically talk to people about is all that tax deferred money in
Yeah.
their IRAs. Again, just as an example, do you want to participate in programs that are forever taxed? Or maybe it might be in your best interest to create a strategy to put that money into never taxed.
Yeah.
And I like to talk about it that way because, do I want to pay taxes forever or never pay taxes on it? Look, I'm talking about, most everyone listening to this, they're going, oh, okay, he's talking about Roth conversions, Roth IRAs. I get that. I hear a lot about that. Brother Joe says, no, it's not the best thing for you to do. Neighbor says, yeah, we've done some of it. There's all these different opinions out there. And you just want to formulate your data and understand what the pros and cons are. Let me just get into some of the things that I look at.
Yes, please.
Number one, taxes are on sale right now. Now, I know that sounds like, well, if this guy's got these quirky little sayings, taxes on sale. It's like I go to Macy's and buy stuff on sale. Yeah. That's what a sale is. What do you mean taxes are on sale? Well, again, I'm really wanting to have the audience listen to this for a moment. And I'll give you an example. I've put together most all of my opinions and studies and my economic information over the past 20 years. Right. So I'm going to relate this back to the year 2000. Specifically, I'm going to cite the 2001 federal tax brackets. In 2001, married filing a joint up to $45,200, you paid 15%. Up to $100,000, you paid 28%. If you do the simple math on that, and you can Google these up and do your own math, you do the math on that, it'll be $22,123. Now, I capped our example at $100,000 of income. So it's easy to look at it and say, okay, well, that's 22.1%. Oh, didn't know that. Here's the other thing that very often we don't know because we're not asking our tax preparers or tax strategists. Why? Because they typically prepare. They don't do strategy.
Right. Yeah.
That's not what you pay them to do. You pay them to do preparation. Strategy is looking at this example. Here's the 2022 married filing a joint return. It's broke down into 3 different brackets. Bracket number 1 is 10%. Bracket number 2, 12, and the third is 22. So the first $20,550 is taxed at 10%. Easy math, $2,055 there. The next from $20,550 up to $83,550 is taxed at 12%. Do the math on that at $75.59. Now that little bit, that $16,450 from $83,550 to $100 is taxed at 22%. You do the math, you put it all together, and that tax is $13,232. Simple example, it's 13.2%. So the question is that yes, taxes are lower.
Yeah.
Significantly lower than they were 20 years ago.
What a difference.
It is an amazing difference. Isn't it amazing?
Wow.
Now, that's just a base to think about. Okay, so I still don't like paying taxes though, even if it's only 13%.
Yeah.
I had this discussion a lot. So I know as a human being, we're looking and we're saying, I don't want to pay that extra money now. Wouldn't it be better for me to just let it go over time? Now, I don't know if taxes are going to go up or not, but most everyone, once they've gone through these calculations, looks at the cost of converting to a Roth IRA differently than they did after talking to Brother Joe and the neighbor and maybe even the tax preparer that says, oh, no, it'll throw you into a higher tax bracket.
Yeah.
Don't do that. Or even CPAs will say, well, we want to do bracket bumping, which means that we're just going to take you up to the next bracket, but not a dime over that. Okay. So there's all these different opinions from the professionals down to brothers and neighbors and so on. Do the math. We walk you through the math just to kind of get an idea of how Roth IRAs are worked But the key thing is they are going to be tax-free to you, to your spouse, and to your heirs. And that's another important consideration. We're thinking about this Roth IRA conversion.
This also ties into that experience, that story that you shared earlier about your airport. Just following the path or going on your own. So,
well, I call it the government's plan or your plan.
yes.
And I know that sounds kind of quirky, but very often in our relationship with those that sponsor products, investment vehicles, and when we read tax law, and we're looking to say, well, they're going to now let me extend my required minimum distribution out to age 73. Mm-hmm. So that's kind of good. Wow, this government's really stepping up for us. I think that there's more taxes in their future by you following that path mm-hmm. than converting. Now, there's already been resolutions that have been proposed to eliminate this thing called the Roth IRA conversion, all right, or phase it out over certain levels of income and so on. Look, the Roth IRA conversion is a loophole. It's not a law. There's nothing in the code that says you can do that. Yeah. It's just allowed under the common coordination of an IRA and a Roth IRA. Mm-hmm. So here again, it's one of those scenarios where, look, we're paying 9% less in taxes than comparable income from 2021.
Yeah.
It's not part of the modified adjusted gross income. All right. So that IRMA calculation for someone, it's not part of that. It's not part of AGI. It's taxable income. Okay. So that's the lowest threshold there of that. So here again, just wanted to kind of give an example associated with that. I'm going to go into another phase here, which is my second passion tax to talk to people about, and that's called inflation, which is a tax. Mm-hmm. Now, look, inflation is bad, all right, but it's much worse than you think. And here are a couple planning tips that I think are important. And if your planner isn't doing this, you want to be asking about it. Mm-hmm. You know, most planning software will default to an inflation rate of 3%. Uh-huh. Just one example. And so I push back on that. And in fact, I push back on that hard, very, very often, and especially accentuated because my clients are walking in and they're saying, have you seen what the price of, and you fill in the blank, eggs. Gas, bread, whatever it is, you know, you fill in the blanks and it's real stuff out there. But I'm hearing stories like it was 59 cents and now it's $4.
Yeah.
Or, you know, I mean, huge differences. I just shake. I honestly don't know a lot of those individual items, but mm-hmm. that is, where did that come from? And so, and here's my simple example. And again, I think the inflation rate is closer to 5 than it is 3.
Yeah.
And let me explain, when you load that into the software, it's much more damaging to have 2% higher inflation than 2% higher in federal income tax.
Right.
Okay. And look, the government controls both. Okay. Mm-hmm. They are pushing those levers for both of them.
Yeah.
All right. And I don't think those levers are being pushed in our direction. And I'll comment on that as I close up here a little bit. But, you know, here's the point. My example is a plain old postage stamp. Plain old postage stamp. In the year 2000, it was 30 cents. Mm-hmm. How much is it today? Well, the new law kicked in 63 cents. So, 33-cent increase. That equates to 4.78% inflation. And that might be tame compared to some of the other examples that we could talk about. So inflation affects financial plans, and the cohort to that is most of the time our life expectancies on average are going to be much higher than we think. in many cases. So I get into that in some of the distribution talks that we'll get into on our next broadcast. And I just, my goal, I think the title of the next is really to expand your knowledge of retirement distribution planning. And as you can tell, it'll intertwingle with, everything that we're talking about here. And I'll just kind of leave you with this thought I thought was very, very precious, especially since recently, the government has stepped up and said, okay, well, we're going to help you with this. And you fill in the first part within the inflation, or we're going to help you with the cost of gas, or whatever the case may be. And what's interesting to me when I say that is that that has been said before, but there was a YouTube. So I grabbed this out of a YouTube, and Ronald Reagan was asked the same question that the current government is saying, okay, we're here to help you. And Ronald Reagan said that the 9 most terrifying words in the English language are, I'm from the government and I'm here to help.
Yep. I love your examples, Ken.
Thank you.
Yes. Thank you so much for joining me. As always, it's always a pleasure. Talk to us more about where we can watch these podcasts.
Yeah, absolutely. So we are active into our podcast series. And so as always, we post everything on our website. So those episodes are recorded. They're posted to the website. So here again, going to the website is a really good resource for you. You can click on the Twitter, the YouTube, LinkedIn, off the Facebook page, off the website. Yeah. And the title of the podcast is called Roadmap to Retirement. And so all those episodes are on there. They're also streamed on the major platforms like Apple and Google, Spotify, Tuned In, that type of thing. So that's how you can go back, give a re-listen. Things that we've talked about. And for those that are inclined, pick up the phone, talk to Jenny Giroux in our office, give us a call. What you see is what you get. We get you on the phone. I'll have these kinds of conversations about real life stuff that's going on out there. And that number is 321-454-23. So go to our website, click in, give us a call. Love to have a conversation with you. No charge. We'll just talk about it, see where it goes from there. Thank you.
I love it. And it's also a great opportunity to listen to these podcasts, videos, pause, take notes. It's also really good to take notes if you want to follow up with the office after. Take advantage of it. So Ken, yeah, as always, I appreciate. And next week's our next Facebook Live. Looking forward to it.
Yeah, absolutely. I am too.
For everyone watching, please make sure to comment, like, and share this video. And Ken, I'll see you next Wednesday.
Okay, great. Thanks a lot, Gina. Have a good week.
You too.